All right, what's up out there to all of my fellow gold diggers? This is your girl Rita, also known as the self-proclaimed gold digger. If this is your first time to my channel, welcome. I am so glad to have you. But if you are a fellow gold digger, welcome back. Y'all know I love and I appreciate each and every one of you. All right, it is Tipsy Tuesday. Tonight's topic, I am so excited. We are going to be talking about credit scores, and I'm going to be giving you tips so that you can improve your credit score and have some financial success. Before we get started, though, let me just check all of my social media platforms really quickly to make sure everything is going like it's supposed to. So if you give me just a moment to do that, then we will go ahead and get started. So let's see. Okay, I am good there. And let me look at one other spot. And then we'll be all set to go to talk about the topic. I do have some church announcements for today that I'm also going to give you as well. All right, and I'm good there. All right, so let's get started. All right. Thank y'all so much for tuning in and joining because I know I had to push it back. It's like 30 minutes late. We were out of town. I was supporting my husband. He had death in the family and stuff like that. So I'm literally just getting back into town. So thank y'all to those of you who stayed up late to catch this live. And thank you to the ones who are also going to be catching the replay. I really and truly appreciate your support. And to all the new people who have joined the channel, thank y'all for rocking with me, being a fellow gold digger, and showing your support in that way as well. Now, if you are new to Tipsy Tuesday, basically what we do each Tuesday night, I come on and I share with you some tips as we take some sips. So tonight I'm just drinking on some water. That's all. It does not have to be an alcoholic beverage that you are sipping on. But tonight it's just water. I'm trying to stay healthy, drinking my water, minding my business. That's all. All right, so let's get into the church announcements really quickly. I'll do the Tipsy Tuesday song because y'all, actually, I'm going to do the Tipsy Tuesday song right now because I want to say the last few times I've been missing it because I've been so excited about getting into stuff where I start talking and stuff. So I'm going to sing the Tipsy Tuesday song. We're going to do the church announcements and then we're going to hit this topic. All right, here we go. Tipsy Tuesday, Tipsy Tuesday, Tipsy Tuesday, get your tips and pass the dues. Say Tipsy Tuesday. Okay, usually when you hear the theme song, that is your official welcome into Tipsy Tuesday. All right, let's do our church announcements. So, first church announcement I have is that Side Hustle Saturday. Side Hustle Saturday is back. If you have not checked out the latest Side Hustle Saturday video, please check it out. It is the last live right before this. And I had a special offer that I'll mention on here as well. And also too, I will start doing Side Hustle Saturday at least once a month. So Side Hustle Saturday is back. It's just not going to be every Saturday, but it will at least be once a month. And I'll usually let you know probably sometime during Tipsy Tuesday if I am going to do the Side Hustle which Saturday I'm actually going to do the Side Hustle Saturday for the month. So be on the lookout for that. We did it for April, so we did it at the tail end of April, so you will definitely get one for May. So Side Hustle Saturday is back. The other announcement I had in regards to that is that I want to help and I want to support you when it comes to your side hustle. And so I know sometimes people don't know what side hustle to get into, or they might hit a wall or hit some kind of challenges and stuff like that. So I am offering a free consultation, side hustle consultation, okay, about your side hustle. So don't don't try to do consultation asking me about, I don't know, life advice or relationship advice or anything like that. It's about side hustles, how I can help you with your side hustle, how I can help you get started with your side hustle, that kind of thing. That I'll have the link. I'm going to drop the link into the comment section and you can sign up that way. The link will be up until Saturday. After Saturday, I will be taking it down so that, I can meet with everybody and all that kind of stuff. But I'll post a link at the time of Side Hustle Saturday. Didn't quite have the link ready, but I know a couple of people have emailed me because that's what I said. Just to send me an email, and hopefully they have signed up because I emailed them back with the link once I had it. So let me go ahead and I'm going to drop that link in the chat. And the last thing I have for our church announcements is that you will get a new video, a recorded video this week from yours truly. Okay. I told y'all I'm trying to do better. I'm trying to be a woman of her word. So I am trying to give the people what they want. So you will get a recorded video this week, in addition to this Tipsy Tuesday video. All right. And that concludes your church announcements. All right, let me drop the link in real quick into the chat. And I see, what's up, Jay Watt? They're saying hi. Oh, thank you. And Jay Watt also says my condolences. Thank you so much. And Still Rocks had jumped. I had replied to him earlier when I had first jumped on. He's not going to be able to make it. But let me put the link in for anyone who wants the side hustle consultation. The link is also part of the Side Hustle Saturday video. It is actually, I linked it in the comment section. So if you look at any of those videos, you should be able to see it. All right. So we talked about what the purpose of Tipsy Tuesday is. I mentioned tonight's topic. So tonight we are going to be talking about credit. And why it is important for you to have good credit and how it can help you and be to an advantage to you. So let's go ahead and get into it. And I know it might be going without saying, like, hey, I already know I'm supposed to have, decent credit or good credit and everything. But I will challenge you and say, having good credit is not just so you can get a loan or a credit card or something, or be able to get, a car loan or a mortgage or something for a house. And that is what I initially thought. I thought you were concerned about your credit score because you needed credit or whatever, or you needed to apply for credit. But having a credit score goes so much deeper than that. So we're going to be talking about that, why it's important to have. We're going to pretty much be trying to, well, let me back it up. So y'all know how I like to get to talking. I have 5 things that I want to talk about tonight, but depending on how things go, it might be a part 2 to this. Okay. So the 5 things that I want to focus on tonight regarding our credit is 1, I already mentioned why it's important to have a good credit score. 2, I want to break down the 5 parts of your credit score. Like, what does that consist of? How does it affect you? That kind of thing. So we're going to be talking about that. The 3rd thing we're going to be talking about is the difference between a credit score and a credit report, because there is a difference. The 4th thing is how you can improve your credit score. That's probably what you want to know. How can I increase it? How can I make my score go sky high? So we're going to talk about ways that you can do that, and you can potentially do this in like 60 days by doing certain things to help improve your credit. And then the 5th thing we're going to talk about is how you can help your kids have a good credit score. And that one for me, since I have my daughter, she's about to be 17 next month. My son, he'll be turning 15 this year. So, when I was 18, I got a credit card just because I wanted to have a credit card. My mama told me not to get one, but I went ahead and applied for one. But I want my kids to be financially literate when it comes to having a credit card, knowing your credit score, because like a lot of this stuff I didn't know. A lot of this stuff I'm going to say a lot of this, some of this stuff I'm going to say a lot of this stuff as I was doing the research, I didn't know that it worked in this particular way or form or fashion. So it's like what I thought I knew, I didn't quite know, or I didn't have a full understanding of. So doing this research has definitely helped me, and I want to be able to help you because I want to improve my credit score as well. So, yeah. Now I will say this, the information that I got was just from various, publications that I found online, as well as YouTube videos. One YouTube video that was very, very helpful and that I would encourage you to check out, I don't have a link to it, is Earn Your Leisure, EYL. They had a someone who I can't remember the title of the video, but they were talking about like your credit score. And it was a young lady on there, and she gave very, very helpful information. So, a good portion of this information is taken and extrapolated from the things that I heard her say in that particular video. So I highly encourage you to check that video out because it is very, very good information. All right, so let's go ahead and get into it. The first thing is why it's important to have a great credit score or a good credit score. And like I mentioned before, it's not just so you can get a loan or get a credit card. And that's essentially, if I'm being honest, that's essentially what I thought it was all about. Like, okay, I just need to have a good credit score because I need to get a loan. These things are important though. If you're trying to get a loan, these things are important. It's important to have a good credit score if you're trying to do these things, but that is not the sole purpose of a credit score. Okay. And I am going to share with y'all my, my Dave Ramsey story because, and I see I had some comments coming in, and I'll put those up in just a moment. I was following Dave Ramsey for a while, and I even did a video about this as well. At one point in time, I was trying to make my credit score 0 because that's what Dave Ramsey had talked about, like get your credit score to 0. And at one time, I was like, I don't care about my credit. I'm trying to get my credit score to 0. So I was trying to get it. How low can you go? All the way to the flow. That's how I felt about the credit score. Because I was like, well, because here's the thing with Dave Ramsey too. He's like, if you buy everything in cash, you have the cash to pay for it, then what's the point of having a credit score? Because you don't need to apply for credit. I realized, I won't say fairly quickly because it was a couple of years before I started changing my philosophy. I realized I do need a credit score, and I need one that's not low. Okay. And definitely not one that is 0. And once I changed how I was viewing the credit score and started actively increasing my score, because it was low. I think it was like in the 500s or whatever. My credit score literally within 30 days like jumped. Either it was 100 points or close to 100 or a little bit more. I don't know. It was around the 100 range or whatever. And I was just shocked and amazed, like, oh, I can make it jump like this or whatever. I was like, all this time I've been spending trying to get it to be 0. To be 0. And then I realized, baby, the things I have going on in my life, I need some credit. And the reason why I say that is because the obvious things, I'm going to list some of the things that involve your credit score. People are pulling your credit score or looking at your credit score or looking at your credit report. The first 6 things I'm going to mention are probably the obvious things that I initially thought was all it was about and stuff like that. And maybe you thought all having a credit score was about. And that is like credit cards. If you apply for a credit card, they're going to pull your credit report, store cards, personal loans, car loans, auto loans, and stuff like that. Mortgages, of course, if you want to buy a house, apartment rentals, or if you're renting any type of home. So like landlords will pull your credit. So those were the obvious things that I figured, you need credit for. And at the time, like I said, when I was following Dave Ramsey's philosophy, I was like, I already have my house. I'm not going to be applying for a mortgage or anything like that. So it's not a big deal if I get my credit score to 0, because I'm like, I'm going to be buying everything in cash, baby. Okay. And I still use cash a lot more since following Dave Ramsey. I still use cash a lot, but I realize I do need a good credit score because these are some of the other companies that also look at your credit score and look at your credit report that I was not aware of. Okay. The next one I'm going to list is bank accounts. Bank accounts, when you're going to open up a bank account, whether it's a savings account or checking account, whatever, they look at your credit score. They look at your credit report. I found this out by doing mystery shopping when I was doing these. Y'all know I like those bank shops and stuff like that, opening up accounts. That's when I found out they pull your credit. I'm like, why they pulling? I had no idea they pulled your credit for things like that or whatever. So banks, I should say, will pull your credit score. Insurance companies will also pull your credit score. So your car insurance, homeowners insurance. So if you're wondering why your car insurance premium is high and you're like, I'm a pretty good driver, and I don't know why my car insurance is high, but you don't have a great credit score, or your credit is not where it's supposed to be, it very well could be because of your credit score that you're having to pay a higher premium when it comes to your car insurance or to your homeowner's insurance. And I can attest, in regards to the homeowners insurance, during that period, it was like a 2-year period where I was trying to get that credit score to 0. During that period, I did see my home insurance jump up like significantly. And I was like, why is it so doggone high? And stuff like that. And I thought maybe it's just because, maybe the home appreciated things. I don't know. I really didn't delve too much into it or whatever, because the first year it had jumped up, but it wasn't a whole lot. And then that second year, I guess because my score had dipped down even more for me trying to get it to 0, it had shot up. I mean, the premium that I had to pay had shot up a good bit, which essentially affects your mortgage payment, because your homeowner's insurance is tied into your mortgage. So it caused my mortgage insurance to go up about $200 a month. That's a lot. That's a significant amount of money. That is a significant amount of money. And at the time, like I said, I didn't realize that was what was being affected. And later on, as I found this information out, I was like, oh, that's why my insurance premium is high. So yeah, I'm up here trying to follow that Dave Ramsey BS, and I'm up here paying, extra $200 a month in my mortgage or whatever. So just be mindful of that. Let me grab the comments and stuff, since I've been talking for a while and I don't want to get too far along. I should have put this comment on the screen, or I should have put it. Let me see, y'all, because it's been a while since I've done this. I'm gonna put it. Let me see if I can put the link as a banner really quick for y'all, and then I'm gonna put the comments up. That way it'll just stay at the bottom, so y'all can see it. All right. And hopefully that won't mess up my comments and everything. Okay. Now let me go back to the comments. All right. Let's see what we have. So this is husband. He says, talk about what is a good credit score range to strive for, please. I will touch upon that, but it'll be later on, and we can talk about that. Yeah, because I won't say that's a tricky question, but there are so many different, I will say this, there are so many different credit scores out there, or types of credit score. This was another thing that I found out when I did the research. The oldest use or oldest score that is out there is FICO, but there's also a Vantage score. But even within the FICO and within the Vantage, there are different versions. And certain versions, they might use, like, say if you're getting an auto loan, they might use FICO version 5. If you're getting a mortgage, they might use FICO version 6 or whatever. If you're getting a credit card, it's FICO version 8. So it's different versions of the FICO score, which they might use to look at. Same thing when it comes to the Vantage score. And that's why sometimes when you are using software like Credit Karma or Credit Sesame and things like that, it might show that your credit score is higher. And then when you actually go and apply for like credit or something like that, they will show your credit score lower. And it's because they're using different credit score models to do the credit score. So to kind of touch upon his question, I'm going to say, y'all know, the higher the score, the better. And I have in the notes somewhere too. I want to say it's like, I can't find it. I forget what the magic number is, but once again, that can kind of change depending on what score is being used. I want to say anything above 740. 740 and above is a good credit, or it's like considered, I won't say you're considered to have like almost perfect credit. What's up, Cynthia? Cynthia says, hi, Rita and the Gold Digger fam. Cynthia is always so welcoming. Oh, thank you, Cynthia. She said she liked and shared. I greatly, greatly appreciate that. And if y'all are already finding this information helpful, please follow suit like Cynthia has done and like and share it for me, please. Cynthia says, I watch guys on the EYL Earn Your Leisure podcast. Also watch the Budgetnista and Anthony O'Neill too. I be trying to stay in the know. That's right. Yes. And I follow them as well. More so the Budgetnista on her Brown Ambition podcast. And Anthony O'Neill, I know he was with Dave Ramsey at one point in time, and he has since broken away and still keeps some of the same philosophies as Dave Ramsey. I don't watch him as much because of that, but I do watch his stuff from time to time. And then Cynthia also says, yes, I found out that banks pull your credit report. Well, I was doing the bank shops too. Yes, I did not know. Did not know. Dealerships want to do a soft pull too. If the guidelines don't call for it, I don't let them pull it. Good, 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 good. Yeah, I figured they would pull it at the car dealership, and that's why I'm, those aren't my jam anyway when it comes to mystery shopping. But that's another reason why I'm kind of hesitant, and even some of the financial institution shops that they have, I'm kind of hesitant on doing some of those because I know some of those things that they're asking for do require they would require like a credit pull. I would think so. But for bank accounts and stuff like that, I had no clue. I had no clue that they were pulling that. But let's get back into it. Into the things that pull your credit report. So I said bank accounts, the insurance companies, so like for your car insurance, homeowners insurance. So please keep this in mind, especially when people are shopping around for new car insurance quotes, or you're about to leave a car insurance company. Car insurance company. You may want to wait until you know your credit score is where you would like it to be, or try and get it a little bit higher before you're so quick to cut off your current car insurance company and not go with them. Now, with that being said, here's the thing that I was going to mention at the end. Just because they pull that credit report or that credit score when you're first applying with them, the fact that you're doing business with them also gives them free reign to pull your credit score at any time or pull your credit report at any time. And that could be for the good or for the bad. Specifically speaking, when it comes to credit cards, that can be for the good because now they could be offering you like a credit increase or something like that, or even new credit, like with a new card or a 0%, interest rate card or something like that. It could be for the bad because now they might decrease your credit limit. They might increase your interest rates because your credit score has changed. So and that was also something that I had to realize. I'm thinking when it comes to my credit score, it's when I'm applying for new credit. No, these people who you have credit relationships with, where you have loans and things like that, they're pulling your credit, or they're looking at your credit on a regular basis to see how you're doing, and they can adjust the terms of your agreement accordingly based on what they find when they look at your credit score. So keep that in mind. Some other people who can pull your credit report or your credit report are employers. They must have your permission to do so, and they can only pull your report and not your score. And I know that to be true for especially like certain industries that you might go into, like banking industries or industries where you're dealing with a lot of money. They want to make sure that you're credit worthy. So be mindful of that. Or certain, jobs and stuff like that. So you might not be able to get a job because your credit score is low. And like I said, me finding out this information, it makes me even more upset that I was like trying to follow along with Dave Ramsey and get my credit score to 0. I'm like, it's so much more than being able to pay for stuff in cash. The credit score, it affects you in so many different ways. The other thing, someone else who looks at your credit score are debt collectors. Now, at first, when I heard this, I thought this was weird. I'm like, why do they need to look at my credit score? They're already trying to collect the debt from me. But usually they're looking at the credit score, the credit report, I should say, because they're trying to verify or get your like name, address, that kind of stuff, so they can collect the debt and everything from you. Utility companies also will pull your credit score, your credit report. And this is important because this could mean the difference between you having to pay a security deposit to get your water or your lights turned on versus you not having to do so. And just to put it in perspective, these can be costly expenses. Like if you're moving and you're trying to get like the best deal on, because when the landlord is going to pull your credit score or whatever, and even if you get approved for an apartment, they could potentially deny you from getting an apartment because of your credit score. But let's say you got approved for the apartment, but you go to turn on the lights or the electricity, I should say, and they're like, oh, you're going to have to put down a security deposit before we can put services in your name. So now you might be paying an extra $100, $200 just to move into the space. And I don't know if they do it with rental insurance, but I'm assuming they probably do since they do it with homeowners insurance. Now you're paying a higher premium for homeowners insurance, rental insurance when it comes to this apartment if you decide to do that. So having a low credit score can be very, very costly. Like I told you, it costs our homeowners insurance to go up like $200 a month. And I'm almost certain, because it was, like I said, it was during the time where I was trying to get the credit score super duper low. I'm pretty sure it was due to me having that low credit score. Other people who, the last one I'm going to mention that can pull your credit score are government agencies, and this can be used to determine your child support payment, also whether or not you qualify for government assistance or your qualifications for government assistance. And if law enforcement has a court order, they can also get a copy of your credit report. So, like I said, it's not just about let me get this new credit card, let me get this new loan or whatever, or let me open up this credit card so I'll be able to get 20% off of these clothes I'm about to buy. It goes so much deeper than that. Okay, now let me see. I see Cynthia has some comments. I'm going to put those up real quick. She says, I've learned from another person I follow that you can get a LexisNexis report to find out what is on your credit report and who looked for it. I don't have the link she shared on the video she made. I have heard of LexisNexis, but I'm not familiar with exactly what it is. Now, since she brought it up, we weren't really going to talk about it tonight, but I'll definitely mention it because I did come across it as I was gathering all the data. You can go to, I want to say it's annualcreditreport.com, and you can get your credit report. And we're going to talk about that so you can know what's on it when we start talking about the difference between a credit report and a credit score. Next thing we're going to talk about is the 5 parts of your credit score. So, your credit score consists of, hold on. Oh, and Cynthia was saying that she is sure it can be Googled. Now, your credit score, it consists of 5 things, 5 parts. And that's your payment history, which is 35%. And these are listed in order from what makes up the most to what makes up the least. So your payment history makes up 35% of your credit score. Your credit utilization, which just means how much debt do you have or how much do you owe, or how much credit you're using, that makes up 30%. The length of your credit history, like how long have you had this credit card or this loan or whatever, that makes up 15% of your credit score. Any new credit makes up 10%, and that's like those hard inquiries when you're opening up new accounts. And keep in mind, if you're applying for and I thought this applied for credit cards too, but I don't know if this is the case because I'll have to look into it. But I know when I was shopping for credit cards, I did this because I thought this rule applied. But when you're shopping they say for car loans and mortgages, usually when you're shopping for those types of things, they know that there are going to be multiple credit inquiries onto your account. And because of that, any credit inquiries that are made within a 2-week time frame, instead of let's say 20 people pulled your credit report during that time frame, or pulled your credit score during that time frame, instead of you having 20 hard inquiries listed on your report, those will only be listed as one hard inquiry because they occurred in that 2-week time period. So I thought that applied for any type of credit. So I did it when I was opening up some new credit cards. Like I opened up a store card. I had applied for a couple of regular credit cards, and I was like, oh, these will all count as one inquiry on my account. Now, I will say this, it did not affect my credit score. So, and that's why I assumed it only was one hard inquiry, because my credit actually went up, but it might've just went up because I was able to get and secure new credit or whatever. So, yeah. Who knows? But they say it only applies if multiple inquiries are made for your car, for auto loans or mortgages within a 2-week time frame. They will only count as one inquiry. But new credit accounts for 10%. And this is the least amount, as well as credit mix only accounts for 10%. And that basically means what types of credit or loans do you have? Like, do you have a good mix, like of different types of loan? Like, do you have a mortgage loan? Do you have student loans? Those are considered different types of loans. Do you have installment loans versus revolving loans? So installment loans means that there is a loan for a fixed period of time, and you're paying a fixed amount over that period of time. So say you have a personal loan where you have to pay $200 each month, and you will have it paid off in 3 years or something like that. That is what's considered an installment loan. The payment is fixed. The term of the loan is fixed, versus revolving loan or revolving credit. Those are like your credit cards. Like, you might borrow, I don't know, $1,000 this month and pay that back, and next month you might only borrow $500. It's not a fixed amount that you're paying. It's like revolving amount, or you're opening up credit, closing down credit, opening up credit, closing down credit, based on what you're buying. So they look at that to see if you have a good mix of credit, and the more diverse your credit is, that helps your credit score. But that only accounts for 10%. But here's the thing, because I like putting all the pieces of the pie together, because these things in a vacuum, it'd be like, okay, whatever. But when you put all the pieces together, literally, you can actively control, or proactively, I should say, actively as well as proactively control 80% of your credit score, because you can control your payment history. You can control your credit utilization, like how much you're spending. You can control, you can kind of control the length of your credit history by not closing down like old accounts. Like, literally, you can actively control that. Okay. And let's talk a little bit more about payment history. Now, it goes without saying, make your payments on time. But here's what I learned. A late payment is not necessarily a late payment. Okay. Credit card companies, and I'm using credit card companies because you will find, when we start talking about ways for you to increase your credit, a credit card is one of the easiest ways to increase your credit. And that's what the young lady that was on EYL's thing was talking about. So credit cards are a good way to easily increase that credit and possibly do it within 60 days. But a late payment is not really a late payment. Late payments are not reported to the credit bureaus until they're 30 days late. So another quick story. Here is me. Sometimes I would forget to pay, my credit card or whatever, and I would have a late payment, or they would say my payment was late or whatever. And they would charge you a fee. They might charge you, $10. Well, back in the day, it was like $10. Now I know it can be anywhere from like $25 to $40, that kind of stuff. They would charge you a late fee because you didn't pay it by your due date or whatever. I remember I'd be all in my feelings, like, how the heck? They know I be paying my thing on time. Now they're going to charge me a late fee. Now you can call and ask them to waive the late fee and stuff like that. And that has worked for me. But sometimes I'll be all up in my feelings and I'm like, oh, they going to charge me a late fee? Well, it's already late. I ain't paying it today. I'm going to wait till next week. And then I'm going to pay it since they already done charged me the little late fee. But keep in mind, pay the daggone late fee. Pay the daggone late fee, but don't wait until the next billing cycle to pay your balance, because once it's 30 days late, that's when it's reported to the credit bureau. So even though your credit card company might say, oh, you missed your due date or whatever, technically it might not be late if they haven't reported it to the credit bureau. So pay it as soon as possible. Pay it as soon as you realize, like, oh, I missed that payment, so that it doesn't count to be 30 days or more late, and then it gets reported to the credit bureau. Okay. And here's the other thing that I found out, and this was from the podcast too on EYL. It takes 11 on-time payments, 11 on-time payments to negate one late payment. So that's why I say, if you're just proactive, That's 35% of your credit score just from making on-time payments. And I know it sounds so simple and sophomoric, like just pay on time, but literally that's all you really need to do is just make the payment on time. And late might not actually be, quote unquote late. You might have a late fee from the credit card company, but they might not have reported that as late to the credit bureaus yet. Okay. And also set up auto pay, even if, and she talked about setting, I want to say it was her because it was several people. Even if you're only setting up the auto pay to pay the minimum balance, just so you can have an on-time payment. Like you can still go back later and be like, hey, I'm going to pay the rest of the balance or something like that. But just so you can have an on-time payment and that count towards your credit, your payment history, go ahead and set that up, and that will definitely help you in your credit score. Okay. And I know, like I said, it sounds very simple, but just keep that in mind. Now, the other thing, the credit utilization, this is where you can really boost your credit score as well. And we're going to talk about this more when we get more into depth about how to do that, so to speak. They say, and this was another thing that was a misconception to me. They say that you want to keep your credit utilization, which is just how much credit you're using or how much debt you're having. You want to keep it under 30%, more so under 10% or at 10%. Okay. And so my thinking with that was, let's say if I had a credit limit of $1,000, and I'm using this round number, if I had a credit limit of $1,000 and I wanted to keep my credit limit under 30% or whatever, I was like, that means I can only spend $300. That is not the case. You could potentially spend more than that, or you can spend $800. You could spend the whole $1,000. But when you pay and when it's reported to the credit bureaus is what makes the difference. If you pay it off and it shows that you didn't spend that whole $1,000, like maybe you only spent, like, let's say you spent $1,000, but you paid it down to where it's showing that you only have $300 left. When it's reported to the credit bureaus, it will look like you only used 30% of your credit limit, even though you had charged $1,000. So when you pay is very, very key to what is reported to the credit bureaus, so that it will look like you only had 30% or even 10% utilization. So be mindful of that. Okay. So it doesn't mean that you can only use 10% or 30%, because that is really what I thought. I really thought, I can only use that amount. You could use the whole thing. You just have to be strategic about when you pay, so that when they report, it will only look like you use 30% and not the full 1,000. Now, the other thing that blew my mind when it came to credit utilization is that, and she said that once you have used 48% of your credit, so going back to that $1,000 credit limit, if you have spent $480 and that is what is being reported to the credit companies, they view that as you've maxed out your credit limit. I was like, say what now? So just be mindful of that. You want to make sure so anything over 48% that you're using to the credit bureaus, it looks like you've maxed out your credit limit, even though you haven't, but they look at anything over 48% as you've maxed out your credit limit and everything. So, and I guess that's why they say keep it, under 30% and 10% and things like that. And once again, going back, it's all about when you pay. So you have to be strategic about when you make your payments to get that balance down, so it doesn't look like you've actually maxed out or you're using the maximum of your credit limit and everything. All right, next thing we're going to talk about, and I hope all of this is making sense to you guys. And that's why I'm like, we control so much of this credit report. Here's the thing I realized too. There is a system to everything. Everything, there's a strategy, it's strategic. There is a system. If you can follow the system, then you will win. Because we don't follow a system, or because we don't have a system, you don't have a system, and I'm speaking, in general, a general you, and I can be talking about me, because we don't have a system set up where, hey, I'm going to pay my credit card on this date, or I'm going to make sure I pay my credit card in full by this. Because we ourselves don't have a system, the system beats us. But when we know the system that these credit bureaus, these credit card companies, all these credit companies are operating off of, when we know the system, we can play by the system and win by the system. But first, you have to put a system and structure in place for yourself so that you can excel in these arenas and stuff like that. Because, and they have to have a system in place, because nobody is really going to want to look into, how many people are in the U.S., and nobody has time to be looking at each individual person's, credit history, credit report, all that kind of stuff. There has to be some kind of systemized tool in place for them to strategically go through and be like, yep, when you do this, this is what happens. When you do this, this is what happens. And we just need to know the rules of the system and play the game according to their rules so that we can win. And that's why I say some of my thinking about what a credit score was, or what the purpose of a credit score was, it had to be debunked. I had to redefine how I viewed that, because I was viewing it from the wrong lens, and that lens wasn't as advantageous to me as how I'm trying to see it now. And once I use it to my advantage, then I'll be able to better excel and ultimately increase my credit score. All right, so let's see. That was 5 parts of the credit score. We talked about the payment history, and we talked about the length of the credit history, and that essentially is 80% of your score. But when it comes to credit history, they mentioned if you are going to be applying for some new credit soon, do not close a credit account or any type of credit account within those 6 months. So if you're going to be applying for a loan, a mortgage, or something like that, you don't really want to do anything in those 6 months. You don't want to close down a credit card. You really don't want to open up any new credit or anything like that within that 6-month time frame, because that can cause your credit score to go down. So be mindful of that. Now, on the bright side, when it comes to, and that goes to your credit history, because now also too, your credit history, what I realized, it's an average. So think of it like your GPA. This is your credit history GPA. So let's say you have an account that is 20 years old, and then you have an account that is 10 years old. If you take 20 and 10, that's 30, and that's 2 accounts. So your average credit history is going to be 15 years, okay? And that's why when you open up new credit, sometimes that can cause your credit score to go down, because your credit history is an average. Okay. Now that's also why you need to have a mix of credit as well, because just like with your GPA, and I'm using the GPA as an example, is because if anyone went to school, or even like, you don't even have to go to college because they use the GPA too in high school, but the more credits you have, like the more classes you take, the harder it is for you to move your GPA either in the up or down. So sometimes when you open up a new credit account, because it's a new account, it doesn't really move your credit average too much, because you have all this other old credit. Now, same thing though, going back to that analogy, if you have that 20-year-old credit card and that 10-year-old credit card, and you decide I like this new 10-year-old, the newer credit card better, and I end up closing my 20-year credit card, you just took your credit history from being 15 years to 10 years. That's a pretty significant difference or whatever. So having that credit mix definitely helps out, okay? When it comes to your credit history, because that is 15% of your score. And what I was going to say is, on the bright side, your credit, the older the card is, it does help increase your credit score. And she was saying that every 3 to 6 months that you have credit open or whatever, that helps to boost your credit score. Keep in mind, it's only 15%, but it does help to boost your credit score. Okay. And then the other things that we mentioned is new credit. We kind of already talked about the hard inquiries. It's only 10%. And then the credit mix is only 10% of your credit score. But 80% is a B average, y'all. A B average will probably get you to where you have pretty decent credit, where you can get just about any kind of credit or loan that you want. 80% of that we can actively control. So just keep that in mind. Now, and I see, like I said, this might be a part 2. If y'all have any questions, let me see. I see I have some comments, so let me go to that real quick. And then I'm probably going to do this next part, and then we're probably going to make it a part 2 because y'all already started late, and I'm not trying to keep y'all here to midnight. We've only done, I told you I want to talk about 5 things tonight. We've only done 2 things. We just finished up the 5 parts of your credit score. Next, we're going to talk about your credit score versus your credit report. But let's see. Cynthia says, yes, she mentioned that too. You just gave me confirmation. I'm going to get both reports and compare. I'm not sure what I was talking about, Cynthia, but I'm glad I'm glad I gave you confirmation. I've been talking too much, so, and not looking at the comments. And then J Watt says, I haven't figured when to pay it to increase my score. Due date is the 9th. So that is probably going to be, I'm going to say this because I want to make sure, I don't want to rush through that part because that is very, very important. So I'm probably going to jump into that in part 2 to make sure, yeah, it's going to be a part 2 to make sure you understand that, because that is the key. That is the key. And I want to make sure y'all really, really get that, because it was like mind blown, like light bulbs went off once I was like, oh, that's how you do it. Okay. So I want to make sure. So next Tuesday, we'll definitely get into that. And I'll probably spend a good amount of time explaining that to make sure that, that y'all have it and understand and be able to implement that, because literally you could implement that pretty much right away once you realize what you need to do. Going back to what I was saying, it's like a system. It's just once you figure out the system, you just play the game according to the system. And then J Watt says, I paid off one of my student loans and it decreased my score by 10 points. Yes. So I'm glad you brought that up. So I am so glad. Well, I'm glad you paid off your student loans. And I am so happy for those people who have gotten like student loan forgiveness. Here's the thing though, going back to my analogy, those student loans, they be on us like a, I don't know, like a redheaded stepchild or something like that. You've had those student loans for probably a long time. So my student loans are older than my kids. Okay. So going back to that credit history thing, because you paid off the student loan, it was probably an old loan, or you had it for a long time. And keep it in mind that your credit history is an average. If you haven't really applied for, I don't know, new loans or new stuff or new credit cards or anything like that, or let's say when you were in college, maybe you didn't have a whole lot of loans other than your student loans and stuff like that, and later on in adulthood, that's when you started doing more of your credit cards and that kind of stuff, you just closed down probably a loan that's anywhere from 15 to 20 years old. So like in the analogy I use, if you have a 20-year-old loan, let's call it your 20-year-old student loan, and you got a 10-year-old credit card, your average credit history was 15 years old. Once that student loan got paid off, using this hypothetical example, now you just cut your credit history to 10 years instead of that 15 years that is more favorable to the credit score gods, the credit score algorithm, whatever you want to call it. Okay. So that's probably why. And like for those people who are getting student loan forgiveness and stuff like that, I'm so happy for them. I will still claim it for myself. I don't care what happened. I ain't gonna say I don't care, but I don't care what happens to the credit score, because whatever they pay off it will more than make up. It will more than make up for whatever dip in my credit score might happen. But I would not be surprised if some of those people who've had their student loans forgiven, and now they're off their credit report, if their credit score it probably has decreased, especially what is it, like the PSLF, public service loan forgiveness, you have to work for 20 years before you even qualify for that. So that's a 20-year loan that now they're going to forgive, and it's totally wiped off your credit score. And to give you a preview of what we're going to talk about next week when it comes to how you boost your credit score, that is why credit cards are a good way to boost your credit score, because they are that revolving debt that they were talking about and not the installment debt. Remember I said, and this is kind of help y'all tie all the pieces together, installment loans or installment debt is a loan that is for, usually you're paying a fixed amount for a fixed period of time. So if you have a personal loan and it's a 3-year personal loan, guess what? After 3 years, it's gone. It's off your credit score. You paid it off or whatever. Versus a credit card, you can have that for, I won't say an infinite amount of time, but you can have that for forever, as long as you're making your on-time payments that we talked about, which is, 35% of your score. I think it is. Yeah. Well, in the 30s or whatever. You can have that for 30, 40 years or whatever, versus these installment or these fixed loans where they get paid off, even the student loans, even your mortgage. Like, probably when I pay my mortgage off, that's a long-term loan. Like, we've been in our house for 10 years, and it's probably, even if we pay it off within the next 10 years or whatever, it's a 30-year mortgage or whatever, but I'm claiming that we're going to pay it off way before then. I'm hoping up for us to do it in 15 years. But if we pay that off in 15 years, that's a 15-year loan that's been on our credit history, and our credit score is probably going to dip because now that thing is gone. But you can easily have a credit card for 15 years and it's still going to keep reporting and everything. So we're going to talk about that. And as I say, 80% of our credit score, we can really, really control and get it to be even higher. Cynthia says, my student loans were, yep, my student loans, I don't mean to laugh in that kind of way. My student loans were dismissed. My credit score went down too. And it just goes back to the credit score. And that's what I say, we just gotta learn the system. It's just a system. And all before, I know I'm speaking for myself, it was just like, I thought that there was, I don't know, it was almost like there's no rhyme or reason to this credit score. Like sometimes, I don't know what I got to do to make it go up or whatever. I don't know what makes it go down. It was just like something that was elusive. Like, I don't know, it's just something that happens or whatever, and you can't really control it, but you really can control it. Jay Watt says, I need mine dismissed. Me too. We gonna touch and agree on that, y'all. And she also said, congrats. And then Jay Watt also says, you're correct. All right, real quick, because we are approaching the hour mark. Let's talk about real quick, and I think I can do this because the next thing was the difference between a credit score and a credit report, okay? And there is a difference, because just like when we were talking about in the very beginning that you can go to, annualcreditreport.com. I want to say that's the site. That's going to give you your credit report. And then we were talking about FICO and Vantage. That is your credit score. There is a difference. Your credit report is free through the free credit report, and you can get that, and you can get it from all the different bureaus. The bureaus are Experian, TransUnion, and Equifax. Those are the three main credit bureaus that your credit is reported to. You can get an annual credit report of your credit for free. What is not free is your credit score. The credit score is what you pay for. And to kind of help you know the difference, this is kind of like, think about in school when you had to write a report. You wrote the report and then you turned it in and your teacher gave you a score. That report, that was all you're doing. That was all on you. And you could easily have access to it. The score, we don't know what it's going to be until the teacher actually grades it. But here's the thing, using that same analogy, your score is dictated on what you wrote, what you have in that report. Just like when you wrote that report for school, your score is dictated on how good or how well you were able to write that report. So if you did a good job writing that report, guess what? You're going to get an A+ or whatever. If you didn't do so good or you just half-heartedly did it, you're going to get a C+ or something like that. All right. So same thing when it comes to our credit score. Based on what we're doing, Going back to, are we making our payment history, credit payment history? Are we making on-time payments? Are we using our credit to the best that it shows that we're using like less than 30% or whatever? And also, how, what is our credit history and stuff like that? Based off of our credit report, that determines our score. So they're looking at that. They're looking at all those different pieces of your credit report. And those are factors that are giving them the score that you're receiving. So, that's why you can have access to your report, because if you can clean up your report, then that will also naturally cause your score to jump up. Now, once again, I think if you saw the post, I was like, I'm not going to be talking about credit repair or anything like that. And I think that goes more so into when you start looking at your credit report and disputing stuff and things of that nature. And that is something you very well can do and cause your credit score to go up because of what is being reported on there. And I still would recommend for you to get your credit report so you can see what is being reported on there. And that is why you will also see differences between the different credit bureaus. And like I mentioned, the 3 credit bureaus are Experian, TransUnion, and Equifax. Those are the 3 credit bureaus. Because some of them might not have the same things, or some of them might have different reports on you, that is what will affect your score. So one of them might have, your personal student loan on there, and another one, they don't have this personal student loan. Or one of them might have where you just got your, Target store credit card, and the other one doesn't have your Target store credit card on there. And that will affect your credit score because it's not in your report. Same thing going back to school. If you've missed out on a key piece that could help your report, you're going to get a lower grade on that report because it's like you missed this detail that you should have put in there that would have really helped your report and would have really helped your score. So yeah, just be mindful of that. The report is all the components of your credit history. How many accounts you have, how many payments you made, even like your demographic information, like your address, all the different places you live, things of that nature. And then based off of that, that's how old your accounts are. That is how they determine your credit score. The credit report is free. The credit score is not. And just like going back to the report in school example. Now, hoping this is a good example. Just like maybe if you turn in your report to your favorite teacher, they might give you an A+. And then maybe if a teacher that is not so much your favorite or that grades a little bit harder, they might give you a B+ on that same report. And that's why with the credit score, some of them, like FICO, Vantage that we talked about before, they're using different criteria to give you the score. And real quick, I'm going to look because I did write it down. One of them is like more favorable. I want to say it's Vantage, the Vantage score. Yeah. So the Vantage score gives you more grace. The FICO score kind of grades you a little bit more stricter. But once again, they each have 5 levels. Like FICO has exceptional, very good, good, fair, and poor. And then Vantage has excellent, good, fair, poor, and very poor. Now, I don't think nobody wants poor and very poor, okay? That's probably like DF area. DF. We're gonna try and stay in AC range. AC range is what we're shooting for. But the FICO is definitely much harder. The FICO is like when you had the grading scale of like 94 to 100 is an A, versus Vantage is like 90 to 100 is considered an A. Okay, so just keep that in mind. Your score can vary because of depending on who is actually scoring it. And just like I said, there are different scoring models, and they will use different scoring models for different types of loans. And I found that out too as I was doing my research. So I want my credit score to increase. I know my husband had asked, like, what is a good credit score to have or whatever, but, or what's, a good one. I want it as high as possible because I know depending on what type of loan I'm applying for, as long as it's in that good range, depending on the model, they might judge it a little bit differently. But a B is going to be a B. An A is going to be an A. No matter if I got a 90 or 100, I'm still going to be getting an A or whatever. So that's also what I want you to keep in mind. Depending on who's scoring it, it could vary a little bit. But if you are in the good range, AB range, you're probably going to be able to get any type of credit that you want, or open up any type of credit account that you want. Okay. And I think I'm going to put a pin right there, and we'll come back with part 2, because we still only have 2 more topics to talk about. But the next one, how to improve your credit score in 60 days, that one is going to be really, really key. And I want to make sure I don't rush through that at all. Okay. Let's see if y'all have any other comments, please. Y'all can put them on the screen. I see Jay Watt has one. I'm going to look at that, and then we'll wrap up. All right. Jay Watt says, I use my Chase Bank app. It includes Credit Journey, which provides my score. They tell me monthly of my score. Yes. A lot of the banking apps, like if you have banking accounts, they will share or tell you your credit score. And then also, if you have any credit cards, usually your credit card company will also tell you the score that they're giving. But also, when you look at that, they will also usually list the scoring model that they're using. Real quick, let me see if I can pull. Let me just see if I can pull up mine and see what scoring model my bank is using. And then it's probably going to be a little bit different for when I use like if I were to pull my credit card. And actually, let me pull up my credit card as well, on one of the credit cards that I have. And I'm going to see what my scores are for those really quick. And then view my score. Where is it? Now, of course, when I go to look for the doggone score, now I can't find it. Oh, here it is. They claim to view your FICO score. This is through my bank. It's supposedly a FICO score. And let me see on my credit card. Let me see what type of score they are using. It's taking a minute for it to come up. So they said, so the bank one is saying that they are using FICO score 9, and it's from, it is from Experian. And let me see what my credit card says. They are also saying they are using FICO score, but they don't say which one. The points are actually pretty close. There's only like a 2-point difference. It doesn't say though, but it is supposedly a FICO score. But it doesn't say which, like if it's FICO score 4, FICO score 6, whatever. It doesn't say which FICO score it is on my credit card one, for whatever reason. But yeah, so they each can use like different ones. So I hope this has been helpful. I hope y'all learned some new things about your credit score that y'all can take into consideration and cause it to increase. And yeah, I'll be back next week with how we can really, really, really improve that credit score, as well as how you can set your kids up to have a great credit score. And just as a quick reminder too, if you are needing a side hustle consultation, I am offering free consultations. Here's the link. You have to, I don't know how you're going to get it. You can copy it. It's also in the chat or whatever. You can copy and paste it. And also, I'll be sure to pin it. I'll probably pin it tomorrow. I'll pin it tomorrow in the comments of this video. It's also pinned in the comments of the Side Hustle Saturday video that I just did. But yeah, if you need help with your side hustle or facing any challenges with your side hustle, that kind of thing, just want to bounce some ideas off of me, we can set up a free consult so that you can be able to do that. Okay. But yeah, and then Cynthia says, thank you. A lot of good information. Thank you, Cynthia. You are always so sweet and kind. So until next time, I hope y'all have a wonderful week, and I look forward to talking to y'all again. I love when I learn new things. Can y'all tell I'm excited? I'm excited when I learn new stuff, especially stuff that I can implement like right away and that I can see a change. Because I'm actually going to start doing some of this stuff, and I'll probably in like 60 days, I'm going to report to y'all how did my credit score increase by just doing these simple things. All right. Until next time, take care, everyone.